Hi, this is Dan Kerr's DK Analytics. It is a cloudy Thursday afternoon on December 19th, 2019. This year is almost spoken for, and here in Southwest Florida, kind of out of sorts for this usually dry time of the year. We've been catching up on some rain that we didn't get in the rainy season, which is a good thing. The topic of my video today is massive new money printing pushing stocks higher still. Let me go through some valuation metrics as is customary. Trade weighted US dollar stood at 91.76, showing a bit of pressure, perhaps even related to this avalanche of new money that's coming out of the Federal Reserve, directly or indirectly. We've got a U.S. 10-year Treasury, which has been under a bit of pressure, perhaps in sympathy with all the additional money that's being created. It stood at a yield of 1.93. Again, the long bond under a bit of pressure. On the other side, in the stock world, which isn't really the other, as I'll get into later, but stocks have been basking and reaching record new all-time highs at all indice levels in the United States and many elsewhere. I'll get into that as well, but the S&P 500 was closing in on 3,200 instead of 3,198 earlier today. Oil also catching a bid, behaving as you think it would in terms of all the fiat currency that is, in fact, entering this world. And by contrast, gold at $14.76 per troy ounce and silver at $17.07 have not been advancing as one would expect given the extremely brash Fed policy to, in essence, debase the US dollar at what I'm going to tell you is a record rate. One housekeeping issue before I continue. I've spent way too many off hours this month trying to make sure that I don't lose my site. My fantastic webmaster out of Bratislava, the Czech Republic, has decided to call it quits. And this has had me scrambling for a new webmaster solution and a cheaper hosting arrangement with GoDaddy. Uh, the, the, the upside to all this, much ado about nothing, has been that, or is that I've been able to reduce my annual cost by another 70% or so. So perhaps that will allow me a bit more flexibility with the site as time permits. And I'm specifically referring to the post side of things. But I'll keep it at that and see what happens. Prior to wading into the topic at hand, again, massive new money printing, pushing stocks higher still as that money printing drops the short end and allows more of a conducive yield curve for buying stocks. That is, there are even less yields to be had at the short end, so people jump into stocks and they get a bid. So, but prior to wading into that, allow me a few political remarks as regards the impeachment hoax. I'm referring to the political, utterly despotic, absolutely contemptible, completely separation of powers, eviscerating impeachment of a president that happened yesterday, and now they're talking about adjusting things, but let me stay with yesterday's decision by the democratically controlled House of Representatives. And this impeachment of a duly elected president, Donald Trump, has occurred despite the president not engaged or not having committed any of the following offenses: obstruction, no obstruction. Trump handed everything over to Mueller's fine team of hacks. No collusion, as the Mueller report concluded. The real collusion, which you probably know, was between the FBI and Donald Trump's opposition. That is, the DNC, Hillary, and a Trump-hating British intel officer to hijack the election rather than some conspiracy between Putin and Trump, which was ridiculous at the get-go. There was no politically driven quid pro quo, as the transcript, which, by the way, was put together by about 10 people or more that listened to the call, I think both in the Ukraine and the United States, but in any case, amongst numerous US bureaucrats that put this transcript together, a consensus of what was said. But that transcript showed zero politically based quid pro quo between the Ukrainian president and Trump. Nothing. Which, as you also likely know, was in stark contrast to Biden's public quid pro quo remarks in the same arena. Specifically, he threatened, as vice president, to withhold U.S. defense funds if a certain individual in the Ukrainian government wasn't going to be terminated before he flew back to the U.S. in 6 hours, because he didn't want that person in the Ukrainian government digging into his son's highly questionable business deals in that same country. Go figure. There was also no bribery by Trump or his administration. Here, as elsewhere, the Democrats did what they accuse Trump and his people of doing. This is a great go on the offense Saul Alinsky tactic, a great cover-up. Blame the people of what you actually are doing and put them on the defensive, and set up a cloud of dust over all your felonious or criminal activity. And even this doesn't get into how Hillary and the DNC financed the utterly concocted Steele dossier, whose equally utterly illegitimate findings, totally based on hearsay, were then put to work with the crooked FBI brass fully on board to get a FISA warrant to illegally, improperly spy on U.S. citizens. Said differently, Trump has committed no treason, no bribery, no high crimes, and no misdemeanors, the old definition that has much higher import. In short, there is no constitutional reason to impeach him, but it happened in the House. If only the same could be said for the other side of the aisle at multiple levels, including, but not limited to, Obama-era elected officials, cabinet members, and top-level bureaucrats from the IRS to the CIA to the FBI and beyond. If the mobster Democrats succeed in their illicit impeachment endeavor, which the House decided on yesterday, either explicitly, that is, to drive the president from the White House, courtesy of the Senate chiming in, which obviously it won't, or implicitly, by crippling the executive branch, which is the much bigger threat, then separation of powers / the rule of law / the Constitution will likely be beyond repair if it isn't already. And what's left of the presumption of innocence, due process rights, privacy rights, right? Privacy rights, property right protections, and freedom will also be lost. Think about it. If this can be done by a fraction of the House of Representatives, by these police state Democrats, to a sitting president, this totally unconstitutional, unethical behavior, then what can the despotic left do to you and me? If what they nearly succeeded in doing to Kavanaugh, that is the judge that was elected to the Supreme Court, turns off other constitutionalists from even being considered for the Supreme Court of the United States, then we'll have increasingly codified tyranny, which, in contrast to our de facto fascism, where you still have private property, this would not constitute a broad-based asset price levitation future. In other words, our asset bubbles today would not be possible, but for a bad reason. Because when you move from cronyism and fascism into further tyranny, communism, then you no longer own a property. That is gone. So without private property, how can you value anything? That's where I'm going. And if you look at the threat here of literally a Marxist takeover of the US government beyond what we already see in terms of the tyranny inflicted upon everybody by the very bureaucracy that is trying to take down Donald Trump, then the threat to both private property rights and what remains of codified freedom will be so tremendous that the market will sell in advance of this coming down the pike. And you know what that means for stock and bond valuations. You know what happens already when there is pronounced financial repression, more pronounced than we already have. For current day flavor of this, look at PEs in Russia or Venezuela. Stepping back a bit, so far the market, the stock market and the bond market, have shrugged the illegitimate impeachment off, much like a cocaine addict addicted to cocaine and looking for a bigger hit. In the market's case, that bigger hit is a massive, peerless liquidity injection. Well, as you know, the Fed hasn't disappointed. The Fed's balance sheet, in fact, has ballooned by a breathtaking $325 billion in 3 months to $4.1 trillion, or $108 billion per month on average, which is far in excess of its most aggressive balance sheet expansion a few years back on a per month basis. If this $108 billion per month rate were to be sustained for a year, which I think is highly likely, if not more, it would result in an unparalleled $1.3 trillion monetary base expansion, which itself would be the equivalent of 34% of the Fed's balance sheet just 3 months ago, and would bring us a record $5.1 trillion balance sheet. For graphic flavor once more, this chart here, I think, gives you a good sense of this. This, again, courtesy of the Federal Reserve Board in Ohio, in Cleveland. This is what I'm referring to. This is the $325 billion increase in 3 short months at 108 billion per annum rate, way beyond what the Fed ever committed to when it had official QE, which obviously now it no longer does, right? And if we sustain this for just 1 year from here, we're going to top the old 4.5 trillion Fed balance sheet by some $600 billion. Well, in a related sense, the productivity misallocating, the productivity eviscerating misallocations that money printing spawns because of those productivity eviscerating misallocations enabled by the printing press, paid for by printed money. Every additional dollar of debt has led to progressively lower GDP growth, something I have continued to flag for years. In fact, during Q3 of this year, each additional dollar of debt resulted in only 24 cents of GDP growth. A few decades back, an additional dollar of debt brought a dollar's worth of GDP growth. In an external financing dependent / debt dependent economy featuring low productivity, Fed debasement in a fractional reserve banking system has boosted debt to ever more outrageous levels. Some numbers as of the third quarter of this year that amply reflect this in the US are as follows. First of all, total debt, financial and non-financial, jumped by $1.1 trillion in Q3, ending September at a whopping $74.9 trillion, or a record 348% of GDP. Year over year, total debt was up a stunning $3.2 trillion. Non-financial debt, meanwhile, surged by $835 billion to $53.9 trillion as of the end of Q3 of this year, which amounts to a record 250% of GDP. Year over year, non-financial debt, in other words, excluding banks and financial institutes, extremely leveraged balance sheets, it was up a whopping 2.4 trillion non-financial debt in the United States, which is 3 times the year-over-year GDP growth to Q3 19 of nearly $800 billion. Government, corporate, and consumer debt are growing and are all at record levels that keep getting increased anew, even as home ownership is near multi-decade lows. Juxtapose that against consumer debt, which is up by $440 billion year over year through Q3 of this year, despite a low level of home ownership, in fact, near a historic low for decades, meaning there isn't mortgage debt outstanding, or there's less because there's less home ownership. And still, the consumer debt has flared up. And very importantly, it's also been rising markedly despite some relatively robust job reports, including, I believe, the 250,000 figure of last month. How does that square? How is it possible if we have such robust job growth that, and it isn't really that robust, but compared to certain market expectations, which were lowered, we had some halfway decent numbers. Why? Because those job growth numbers are fake, or largely fake, right? They depend upon a birth-death business model, which is statistical sleight of hand. They don't uh, consider the fact that a lot of high-paying job losses have been replaced by two or more part-time jobs without benefits and poor pay, which then get tallied up in job gains. So this whole thing doesn't fly based upon the debt that's being created, right? At the consumer level, also at the corporate level, although that's aggravated by stock share repurchases. But what I'm trying to say is, how does one spell back to the consumer debt rise despite lower housing ownership, despite solid so-called payroll growth? How is it possible then that this makes any sense? It doesn't. Well, I'd say, how does one spell fake job reports, President Trump? Remember candidate Trump? I do. I think you do too. Federal government borrowings, meanwhile, if we look at some of the numbers that reflect this increasing dependency upon debt, even as GDP growth grows perennially weaker and more questionable in nature. Federal government borrowings rose at a 10.4% rate in the third quarter year over year, and federal debt over the past 12 months grew by a whopping $1.3 trillion through the end of November. If you want the true deficit, that's the number, not the one they published that's two-thirds or half as much. Again, more statistical sleight of hand, more fake numbers, President Trump. The U.S. money supply, the M2 money supply, has been surging of late. It is up an unprecedented $1.04 trillion over the past year, or by 7.3%, paced by a more robust money multiplier. I believe an inflation expectations-based increase, including the trade war fallout, trying to get ahead of heightened import prices. And I think it's also supported or underpinned by a dramatically widening Fed balance sheet as of early September. You bring those two things on board, I think that has reawakened money supply growth. Meanwhile, the biggest bubble progeny of the Fed and other central banks, obviously bonds and stocks, have surged year to date, with the Fed returning to unprecedented currency debasement while driving the short-term rates down by repo, hook, or crook. The risk trade is on. By the way, the Fed has committed to purchasing over $500 billion in repos in order to drive down short-term rates and to ensure cheap casino money for Wall Street. With 2019 almost history, consider the following returns with slender dividends and coupons on board. That is, it's mostly capital appreciation. The S&P has returned a whopping 30% so far this year. The NASDAQ up 33%. European stocks too have been on a roll, with both the DAX and the FTSE returning in the mid-20% range. The 10-year treasuries have returned 14%, notwithstanding the recent backup. And a basket of junk bonds, as measured by the Bank of America High Yield Index, is up roughly 14%. Gold and silver, meanwhile, while strong earlier in the year, are bringing up the rear with 15 and 10% dollar returns, respectively. Against this backdrop of massively higher money creation and its ever more bloated cousin debt, why aren't silver and gold reflecting the ever closer financial and economic train wreck. First, it's risk on. Interest rates at the short end back down the floor. Can't earn anything on your money. People pile into stocks. Second, there's a long and tired story that continues until it doesn't. I'm referring to the huge naked short positions in precious metals allowed and arguably engineered by our fiat currency caretakers, not, and their henchmen. Naked short positions, which curiously wax whenever precious metal prices get stronger. This manipulation is a well-documented fact, but it goes unpunished, save for select small fine wrist slaps for banks earning untold billions. And let's not forget who owns the Federal Reserve, the Fed. Clearly, the powers that be don't want, or want rather, to keep fiat money up and real money down. My point, neither undeserved confidence in fiat money nor the huge naked short position manipulation down of precious metals prices have ended. And once again, it's not a question of if they'll end, only when. Quite the strategic allocation cue, albeit only for the patient investor so far. That will change. Speaking of precious metals, let's take a different look than I have in a very recent past. Let's look at them in terms of the Dow. Specifically, how many troy ounces of gold are required to buy it, which is also known as the Dow to gold ratio. I'm using the Dow given its longer historical significance than the S&P 500, but the result that you're going to see won't be much different. Taking the Dow and dividing it by an ounce of gold gives us a sense of how expensive the Dow is in gold terms, and how attractively priced gold is in stock terms. Note that we are much closer to a record high in the Dow compared to the price of gold than to a record low. Translation: in gold terms, and by extension silver, the Dow is very expensive and gold is very cheap. Let me show you this graphically. Let's see, here we go. Here's the Dow to gold ratio. We're here currently. That is, you're with a Dow above 28,000 and gold below $1,500 per troy ounce. You need roughly 19 ounces, all right, of gold to buy the Dow. We've been all the way down to just one, and nearly one in the 30s, one in the late 70s, early 80s, and that's when gold was really expensive, okay, measured in stock terms. Now, up here, gold is very cheap, measured over nearly 100-year period in stock terms. That is, among other indicators, a sign of just how cheap gold is and or how expensive stocks are. And I'm using the Dow here as a sort of faulty but better than nothing indicator, not only of U.S. stocks, again the S&P would be more representative, but of stocks globally in a broad sense. All right. Now, if the dollar price, or if the dollar gold price reached parity to the Dow's current valuation, that is, 1 ounce of gold bought 1 Dow, then obviously the price of silver would be over $28,000 per troy ounce, because that's where the Dow is. If, on the other hand, the Dow imploded by 64% to 10,000, which I think could happen easily given what's on offer, as frequently described, including here and what I'll get into in a second, Dow to gold parity, 1 ounce of gold buys the Dow, would yield a $10,000 gold price. That is, the Dow would go to 10,000 and gold would go to $10,000 per troy ounce. Also very possible. In fact, I think much more likely than the former scenario, given what I think is going to happen to stocks, as I'll get into. From 19 ounces of gold down to 1 ounce of gold to buy the Dow, even if the Dow collapses, it's going to mean a much higher gold price. This is where I'm going, right? In this regard, also note that precious metals are negatively correlated to stocks and bonds, and that the coming financial, economic, political, and societal tsunami will prick both confidence and bubble asset prices while triggering a reallocation into the only true safe haven investable portfolio harbors incredibly scarce gold and silver. In a related manner, let's consider where the S&P 500 is trading in terms of a trailing 12-month PE, and that PE based on GAAP earnings, meaning all-in accounting. That is, if we have a modern day portfolio business complex where we have sustained restructuring charges related to purchasing and selling assets, purchasing businesses, selling businesses, taking write-downs of underestimated expenses, and so on and so forth, that all those pieces of the puzzle get reflected when appropriate in the expense part of the income statement. And they cannot just be ignored as operating earnings do, non-GAAP earnings do, unless the company exits the business line, right? Well, operating earnings just take all those recurring restructuring charges and ignore them, which puffs up earnings and earnings power to an absolutely unrepresentative reality size. This is why I keep going to GAAP earnings. And if one looks at the S&P 500 PE on a trailing 12-month GAAP earnings basis, the PE ratio is 24, all right? How does that grab you given where we're likely to be on the edge of an earnings cliff, all right? Speaking of that cliff, we have one after another sign of gathering economic weakness, be it in manufacturing, in transportation, in services, in consumer spending, or in global trade. In other words, what I've been drawing to your attention, what I have been drawing your attention to for months suggests a sharp fall off in the S&P 500 EPS tally is just down the road, something that a record-long expansion of 10 years makes even more likely. Why? Because we always have business cycles. Call it a law of economic nature, or call it human behavior. We always repeat the same mistakes, not precisely in the same manner, but we then pick up the pieces. and we've got that still in front of us. Let me restate that year over year S&P 500 EPS momentum has already dissipated, and in fact it went nominally negative in Q3 in year over year terms, something like minus 3%. I discussed this in my Halloween video. When GDP growth goes negative just slightly, EPS residuals, the S&P 500 EPS residuals get walloped. I'm talking 50+% compressions being typical in that earnings residual, which is a tiny fraction of the top line because not all the costs can be taken out as quickly. And I think those coming around the corner sooner rather than later, in the very least, EPS hits the compression 50% plus that I think is in the offing. That could well stay down for the count, as happened last time around, when it took some 5 years for EPS to recover the prior peak earnings levels. This time around, with our even much greater debt and much greater misallocation-based baggage on board, from redistributionism to third world amnesty to ridiculous energy subsidies, it's going to be tougher to dig out of this hole. And this is even more true if one considers the pronounced financial engineering / stock buyback based nature of our current fake EPS pinnacle. EPS that probably will have a harder time coming back for all those reasons, much less eclipsing the current EPS tally as measured by the S&P 500. I'm trying to say that this in aggregate makes the current S&P 500 PE of 24 that much more precarious. Why? Because the stock market's current bubble valuation is susceptible to a two-pronged deflation. First, a 50% plus EPS compression, which would cut the S&P's current quote of nearly 3,200 in half or more all by itself, assuming a 24 PE could be sustained. Second, with interest rates artificially on the financial repression floor amidst mounting default and monetary inflation risks, stocks, net present values, will not only likely get clocked by a stout EPS compression, but by substantially higher discount / interest rates, themselves reflecting the ultimate end and reversal of a long in the tooth, increasingly artificial, financial repression overdosed 38-year-old bond bull market. So what's the takeaway for investors? That stocks and bonds travel together. That is, they rise together and they fall together. Let me bring an S&P 500 earnings yield on board here onto the camera, which I've referred to multiple times. This is courtesy of Yardini and Associates. Here we go. If you take a look at the red line, that's the Treasury yield, the 10-year Treasury yield, and the blue line, which hugs more or less the red line, in other words, they move more or less in tandem. The blue line is a reverse of the PE. That's what an earnings yield is. Instead of a PE, it's an EP. Let's say we had a PE of 10 and we flip those two, we'd get an earnings yield of 10, right? A PE of 5 would give us an earnings yield of 20. PE of 7 or 8 would give us an earnings yield of about 13, 14. See that blue line? Or 14, 15. This is also what I'm saying, that when PEs head south, earnings yields head north. And when PEs head south, then bond yields head north. That is the reverse of the PE. The earnings yield of companies travel together. In other words, perhaps better said, stock and bond valuations travel together. As interest rates rise, obviously bond values fall. And as interest rates rise, earnings yields of stocks rise and PEs fall. So stocks fall as bonds fall, related to rising interest rates, which are then the discount rates that are used for stocks, historically with a premium for greater risk that shareholders have because they're last in line to get anything out of the top line, right? I just made that up. Sounds pretty good. What we've seen here is a 38-year-old decrease in interest rates and therefore discount rates for stocks. That makes them a lot more valuable when you discount back future earnings at lower interest rates. And the opposite is also true. It makes them a lot less valuable when the interest rate goes up. That's this. I think this is where we're going. Back to this, all right? And we could go even a lot further than I think, given that we're so off the charts, ridiculous in all matters, debt, money printing. So we've got default risk, we've got monetary inflation default risk, we've got massive misallocations, drooping productivity, less property right protections, less freedom, all these things that I keep mentioning, yet we have stocks and bonds priced for perfection. An utter and total financial repression engineered disconnect, which is a budding risk for those invested in bonds and stocks that they purchased at very elevated prices, and as an opportunity for those to take profits for expensive bonds and stocks purchased at expensive prices, get out of harm's way, take that intact capital, set it aside, devote some of it to precious metals because they will likely be cash on steroids. So not only will you avail yourself of stocks and bonds with stocks yielding again in the single digit range and bonds somewhere in a double digit territory, not only will you avail yourself of those, but in the interim, that cash is likely to be cash on steroids. That is, if you purchase physical gold and silver and keep it outside of the banking system. In closing, I hope this video has provided you with some useful strategic allocation, food for thought, and you know that strategic can become tactical overnight. I thank you for tuning in, and I wish you and your family a merry, reflective Christmas filled with quality time together. I also wish you a prosperous, happy, and most of all, a healthy 2020, almost dead ahead. This is Dan Kurz. It is December 19th, 2019. I'm going to sign off, but before I do, I want to tell you that I hope that I can be back in a small micro-channel way next year. I should also tell you that the collaboration being a squatter on the SGT site has ended, so it's going to be this effort by itself without training wheels from SGT and the other people. So we'll see what happens. And like I said, perhaps you'll see me, or indirectly we'll see each other. And I always appreciate the comments that you make once I post these videos. That's it from here. Bye bye.